Welcome to another exciting episode of Financial Insights in Minutes. Are we teetering on the edge of economic disaster? We'll break down the latest from Japan's shocking yen news to Trump's speculated Bitcoin announcement.
Expert predictions on stock market sell-offs and a potential recession will keep you on your toes.
Don't miss this critical financial news roundup. Your portfolio could depend on it.
Stay tuned to hear the verdicts, and be sure to like and subscribe.
First, Michael Gade explains how Japan's financial maneuvers are disrupting U.S. markets. Next, Lance Roberts and Adam Taggart discuss the ominous widening of credit spreads. Then, Neuner speculates Trump might announce Bitcoin as part of strategic reserves. Following that, Game of Trades links rising jobless claims to a possible recession. Jim Rickards stuns with his claim that the U.S. might already be in a civil war. Jack Farley recaps Ethereum's rise amidst a grim conference mood. Chris Ciovacco questions if stocks are moving into a risk-off mode. Finally, Joseph Wang analyzes the political impact of J.D. Vance as Trump's running mate. Welcome back to the David Lin channel. Today's agenda. Did Japan just throw a wrench into the U.S. financial system? Michael Gade of Tidal Financial Group weighs in on the yen's dramatic moves and much more.
Oh, it's going to be a ride. Michael's insights cover everything from yen carry trades to small-cap surges. Let's dive right in and untangle this web.
So, what's the main takeaway from Michael's analysis? Why should we care about the yen's story here in the U.S.?
The core thesis is riveting. Japan's interventions to stabilize the yen might trigger broader U.S. financial implications, specifically in treasury markets and tech stocks. It's like financial dominoes.
Let's break this down a bit more. What's this yen carry trade all about, and why should I be worried?
Good question. Investors borrow yen at super low rates and invest in hot U.S. stocks like Nvidia. If yen appreciates, those investors feel the pinch of more expensive repayments, thus forced to sell assets. Unwinding this trade could shake things up big time.
And what does this mean for U.S. treasuries?
Japan might need to sell U.S. treasuries to buy yen and support their currency. This could create tremors in the treasury market, potentially leading to a broader asset panic, but ironically also driving money back into treasuries for safety.
Interesting. Now about the small cap rally. What's that all about?
It's another twist. Hedge funds were shorting small caps and going long on large caps. When large caps start getting sold, small caps rally as part of a short squeeze. Michael suggests this could be a mechanical unwind, not a sustainable trend.
What does Michael foresee for yen and market volatility?
He predicts that the yen will continue to appreciate, causing forced asset sales and increased market volatility. This could propel defensive sectors like utilities while hitting tech stocks hard.
So how should we wrap this all up? What's Michael's final call?
Michael underscores the interconnectedness of global markets. The yen's appreciation isn't just a Japanese issue, it's a potential catalyst for broader financial disruptions. He advocates for caution and a defensive market stance, keeping an eye on sectors like utilities.
Welcome back to Thoughtful Money on YouTube. Today's episode is jam-packed. We're talking market turbulence, political ramifications, and some personal stories that hit close to home. Who's ready to dive in?
Absolutely. Adam Taggart teams up with portfolio manager Lance Roberts to give us a rundown on why stocks had such a rough week. Trust me, you don't want to miss their insights on market dynamics and those widening credit spreads.
So, what's the big takeaway from Adam and Lance's discussion this week?
The core focus is the recent market turbulence driven by widening credit spreads. Lance discusses why these spreading rates, particularly in junk bonds, are a warning sign. They also dive into other market dynamics and potential political impacts on the economic landscape.
Let's break that down further. What's happening with credit spreads, and why should we care?
Lance highlights that we're seeing credit spreads widen, especially in extreme junk bonds. While these aren't panic-inducing levels yet, there's certainly something to keep an eye on, as they could foreshadow a market event.
Got it. And didn't Lance just get back from a little trip?
Oh, yes. Lance shared some personal stories from Greece, including how Mediterranean food was the highlight. But the real adventure started when he got back to Houston, facing the aftermath of Hurricane Beryl.
Wow, from Mediterranean shores to hurricane woes, quite the transition. What market insights did Lance and Adam share this week?
They discussed how high leverage among hedge funds in big tech stocks contributed to recent volatility. Despite the corrections, Lance sees potential buying opportunities in these tech stocks as they correct to more reasonable levels.
Speaking of volatility, what political impacts are they analyzing?
They delve into former President Trump's potential re-election and its economic impact. His proposed policies like aggressive tariffs, corporate tax cuts, and isolationist foreign policy could drastically reshape the market dynamics.
It's going to be a wild ride if all those policies come to play. What did Lance have to say about his investing strategies?
Lance mentioned they've been adjusting portfolios by reducing weights in overextended tech stocks and raising cash to manage risks effectively. It's all about being prepared for potential market swings.
Smart move. They also touched on some financial planning advice, right?
Absolutely. They stressed the importance of having an estate and succession plan, especially for DIY investors. Establishing a relationship with a trusted financial advisor now can save surviving family members from future confusion and ensure a smooth transition.
All right, time to get the crystal ball out. What are Lance's predictions?
First up, Lance anticipates further market corrections. He suggests we could see the market testing lower support levels if economic data continues to show signs of weakening.
And the economic outlook?
Lance predicts that continued deterioration in economic data could push the Federal Reserve to cut interest rates sooner, possibly as early as September, if significant indicators show decline.
So, what's the final takeaway from this episode?
Lance wraps things up by calling for cautious optimism. While signs of economic slowdown and market corrections loom, it's crucial to stay vigilant, manage risks, and make informed decisions. And, for heaven's sake, have a solid financial and estate plan in place.
Welcome back to Kitco News. Today we're diving into a spicy subject, the speculation that former President Trump might make Bitcoin part of the United States' strategic reserves. We have Michelle McCory providing some eye-opening details from her latest interview with crypto expert Rand Neuner. This is going to be one wild ride, so buckle up.
Indeed, this potential move could shake things up big time. Michelle and Rand explore how Trump's possible endorsement could make Bitcoin a strategic reserve asset akin to gold. The impacts on the market and the broader economy could be massive.
So, what's the big takeaway? What's Trump allegedly cooking up with Bitcoin?
The core thesis is that Trump might announce Bitcoin as a part of the U.S. strategic reserves at the upcoming Nashville Bitcoin conference. This could have huge implications, not just for the U.S., but globally, as other countries might follow suit.
Let's break down the key points, starting with Trump's potential announcement. What's the scoop?
Trump is speculated to announce Bitcoin as part of the U.S. strategic reserves. The U.S. already holds about 200,000 Bitcoins, seized from various operations. Imagine adding those to the strategic reserve. It's like turning Bitcoin into digital gold.
Interesting. Now, Trump seems to be tapping into a certain group. Who are these influential crypto advocates?
Exactly. Trump is aligning with wealthy, influential folks who are big on crypto. Jamie Dimon, a notable former skeptic, is even being considered for Secretary of the Treasury, a huge signal shift if true.
Okay, but what does this mean for the market? Any immediate reactions expected?
A Trump announcement could trigger a global FOMO effect, prompting other countries to jump on the Bitcoin bandwagon. Cover your ears. Bitcoin prices could skyrocket faster than a SpaceX launch.
Let's talk about some broader economic impacts. Any recent events shaking up Bitcoin's price?
Definitely. Legal sell-offs by governments like Germany and concerns about the impact of seized Bitcoin hitting the market have affected Bitcoin prices. And don't forget the new Ethereum ETFs expected to hit next week. Lots of moving parts.
All right, time to pull out that crystal ball. What are Rand's predictions?
Rand predicts Bitcoin will break the $74,000 mark in 30 to 60 days, launching a bull market that could push Bitcoin to $150,000 by early 2025. Hold on to your hats.
And he's eyeing the Fed too, right? What's going on with interest rates?
Absolutely. He's predicting at least one rate cut by year-end, possibly more in 2025. Lower rates typically drive more investment into risk assets like Bitcoin. It's like handing out candy at a parade.
To wrap it all up, what are the big takeaways here?
Rand's bullish on Bitcoin and crypto markets, fueled by a mix of potential political changes, strategic asset status, and macroeconomic shifts. He advises keeping an eye on these developments because the next bull market could be one for the record books.
Welcome back to Game of Trades. Today we're diving into a fascinating video titled Only 3 Months Left Until It Starts. We're going into the nitty-gritty of rising jobless claims and their ominous implications.
That's right. If you've been nervously eyeing those jobless claim numbers, you're not alone. This video breaks down the historical patterns and their significance for our financial future.
All right, cut to the chase. What's the core thesis of this video?
The main thesis is that the recent rise in initial jobless claims could be an early indicator of an imminent recession. The big question is whether this uptick will lead to a downturn or if it's just another false alarm.
Historical trends. Always a good start. What does history tell us about these claims?
Rising initial jobless claims have preceded every U.S. recession. Recently, jobless claims increased from 190,000 in January to 240,000, a worrying 20% hike.
But is it a guaranteed recession indicator? Any false signals we should be aware of?
Not every uptick signals doom. Sometimes these rises don't lead to a recession, hence the investigation into whether current trends are accurate warnings or just noise.
How's this all going to hit my stock portfolio?
Historically, rising jobless claims lead to stock market downturns, with crashes ranging from 20% to a whopping 60%. The outlier was 1979, where the S&P 500 stayed flat.
What about the usual suspects, like the labor market indicators?
Labor market red flags are waving. Fewer people are finding jobs plentiful, while more are finding jobs hard to come by, a classic pre-recession signal.
And the notorious yield curve.
The yield curve is a dead-eye predictor of recessions. It's been inverted longer now than it has been since 1929, a strong indicator that trouble is brewing.
But there's talk of a disconnect between the economy and the stock market. What's that about?
There are phases where jobless claims rise, but the market doesn't price in a recession. It happened in several past recessions. Seems like history might be repeating itself.
Time to break out the crystal ball. What's on the horizon?
First, despite rising jobless claims, the yield curve hasn't shown its typical steepening signal yet, suggesting we're close but not quite there for a recession. Secondly, if we follow past patterns from '89 and '07, the stock market may continue to rise for another 100 days, or roughly 3 months, before peaking and then dipping.
So what's the final word on all of this?
Prepare for a potential recession, but use the next 3 months wisely. The market might still give us an uptrend, so it's strategic to ride this bull while being cautious of the underlying economic signals.
Welcome back to the Julia LaRoche Show on YouTube. Today's episode promises an intense ride as we dive into whether we're already in a civil war. And who better to discuss this with than Jim Rickards, a renowned investment advisor, lawyer, economist, and best-selling author. Julia is in for a gripping conversation.
Absolutely. Jim's insights are always eye-opening, and with topics covering political instability, economic turmoil, and even an assassination attempt on Trump, we're in for a deep dive into some heavy issues.
So what's the gist of Jim Rickards' argument here? Are we really in a civil war?
According to Jim, yes, but not in the traditional sense. He argues that the U.S. might already be in a civil war, fought through courts, media, and ballots, instead of guns and battles. The political instability we're witnessing is just the tip of the iceberg.
Let's break that down. What are the key points Jim brought up about our political landscape?
Jim highlights the domestic chaos with the Trump-Biden saga and points to the broader global issues we're facing, like the war in Ukraine and the anticipated rise of the BRICS currency. It's a political whirlpool out there.
And about that assassination attempt on Trump, the story sounds wild.
Indeed. Trump barely avoided an assassination attempt, and Jim criticizes the Secret Service for their gross negligence. He even suggests there may have been some passive participation, which makes the story even more ominous.
That's chilling. Could this have had broader repercussions?
Absolutely. Jim believes that if the attempt had succeeded, it could have sparked militia-like violence, nudging the U.S. even closer to a full-blown civil war. Scary stuff.
All right, now for the crystal ball moment. What is Jim predicting?
First up, he sees a strong chance of a Trump victory in the upcoming election. Trump's ahead in pivotal states, and Jim anticipates a significant lead in the Electoral College.
Interesting. Any dramatic twists we should brace for?
Oh, plenty. Jim suggests that Biden might be advised to step aside, making way for Kamala Harris. And get this, Barack Obama could be a surprise pick for vice president, which would completely shake up the dynamics.
So what's the overall takeaway from Jim's discussion?
Jim underscores the need for caution and strategic planning amidst growing political tension. With so much at stake, it's crucial to stay informed and prepared for the unexpected twists and turns ahead.
Welcome to Blockworks Macro's weekly Roundup. We're here to make your week better, breaking down all the latest on the stock market and crypto trends. Buckle up for some sharp insights.
Absolutely. We're digging into today's topic. Why are the stock market and crypto acting like the cool kids while conference vibes are like a bad high school reunion? Let's make sense of this pronto.
So, the week's hot topic, why the sad faces at the Ethereum conference? Wasn't the market supposed to be rolling in dough?
You'd think. Despite Ethereum and Bitcoin's stellar performance, the mood at the ETHCC conference was surprisingly glum. Jack Farley noticed an uncanny disconnection between market numbers and industry sentiment. Like, where are all the new faces?
Interesting. Let's break down those key points. What was the vibe check at the conference?
Even with Ethereum rallying 60 to 64%, the conference felt like a We Survived 2020 support group. No new users, fewer projects, and many veterans seemed ready for retirement. A bit like a tech ghost town.
Ouch. But the markets are doing well, right? How does that reconcile?
Right? Market gains are there. Ether up 64%, Bitcoin at 40%, and the QQQ's up 16.5%. The bearish sentiment at ETHCC contrasts sharply. It seems like a puzzle of thriving markets, but cautious investors.
So what's moving these pieces? Institutions? Politics?
Bingo. Institutional players are diving in, while some retail investors pull back. And politically, whispers about Trump speaking at a Bitcoin conference and China's possible return to Bitcoin trading are adding scent to this economic stew.
All right, it's crystal ball time. What predictions came out?
Farley foresees commercial distress hitting the consumer arena, which could tip us into a recession. But positive scenarios are on the table too. Trump's policies, if they favor crypto, could significantly shake things up, and institutional interest steadies the ship.
Wrapping up, what's Farley's big takeaway?
He's spotlighting the shift in market dynamics, institutional adoption over retail speculation. An informed eye on macroeconomic changes and political winds is crucial. It's a wild ride, folks, but knowing the terrain can make all the difference.
Welcome to CiovaccoCapital on YouTube. Today we're turning the spotlight on whether stocks are rolling over in a risk-off manner.
Yes, and guiding us through this roller coaster is the insightful Chris Ciovacco. Buckle up, because we're going to dissect the health of the stock market and see if we're looking at a bear market, a correction, or just a healthy rotation.
Let's get to the meat of it. What's Chris really getting at in this video?
The crux of Chris's analysis is determining if the current market trends point to a bear market, a pullback, a correction, or possibly higher highs on the horizon. He examines the S&P 500, tech stocks, small caps, and more to understand any shifts in market leadership.
All right, break it down for us. What are the key indicators Chris looks at?
First off, the leaders since last October have been the S&P 500, tech, growth stocks, and communication services. Other sectors, including small caps and bonds, have lagged behind.
Got it. How about those current trends?
The charts show healthier trends now compared to early 2022. For example, the 20-day moving average is much higher, suggesting a stable long-term trend. The Nasdaq 100 and small caps charts are also looking strong, though more confirmation is needed for small caps.
And the comparison across sectors?
Most sectors like real estate, financials, healthcare, and consumer staples are still in downtrends. Only tech and communication services are consistently outperforming, although even they appear to be showing signs of vulnerability.
All right, let's look into that crystal ball. What does Chris predict?
Chris suggests that any counter-trend move is likely a healthy rotation, and we're probably looking at some sideways movement in volatility rather than a significant correction or devastating bear market.
So how does it all wrap up?
Chris concludes that while there are some vulnerabilities, particularly in the tech sector, the overall indicators do not signal an imminent bear market. The key is to stay flexible and open-minded as we navigate through these evolving market conditions.
Welcome to Joseph Wang's YouTube channel. Today we're diving into the latest Markets Weekly update from July 20th, 2024. Joseph is live from the road at the Monodum Conference in San Francisco.
Absolutely. No fancy slides today, just straight-up market insights from the ever-astute Joseph Wang. Let's see what's shaking the financial world this week.
So what's the big news Joseph focused on this week?
The core thesis revolves around J.D. Vance joining Trump as his running mate, which could significantly increase the chances of a big U.S. dollar depreciation if Trump clinches the presidency. It's like setting the stage for a financial plot twist.
Let's break it down. What are the key points Joseph made? Starting with the political landscape.
J.D. Vance being Trump's sidekick is huge. It signals a possible shift in economic strategies towards weakening the dollar to boost U.S. exports.
Interesting. What about the historical context? Anything from Trump's previous term that might give us a clue?
Definitely. Last time, Trump slapped tariffs to boost U.S. exports. This time, they might add currency depreciation to their toolkit. It's like leveling up in economic strategy.
And how exactly could they depreciate the dollar?
There are several ways. Imposing tariffs, driving market sentiment a la Trump's Twitter, or even creating a massive sovereign wealth fund to sell dollars and buy other currencies. The options are plentiful.
Now the big question, how does this impact the market?
Short term, it could be bearish. Foreign investors might ditch U.S. assets to avoid currency losses, but in the long term, a weaker dollar could actually make U.S. assets more competitive globally. Bit of a mixed bag there.
All right, let's gaze into the crystal ball. What are Joseph's predictions?
First up, if Trump's in, expect the dollar to dive. It's almost a sure bet with the current political setup.
And for the market?
Hang tight for some short-term turbulence. Foreign investors could flood the exit gates, hedging their bets or liquidating U.S. assets.
But long term?
In the long run, a weaker dollar could benefit U.S. exports and stock markets. Think of it as a storm before the calm, but quicker.
To wrap it all up, what should we be watching for?
Keep an eye on these political developments. Short term, brace for some market bumps, but long term, the weaker dollar could be a boon for U.S. competitiveness. Stay tuned and don't forget to check Joseph's blog for more in-depth analysis.
Michael Gade warns us about Japan's financial maneuvers shaking up U.S. markets, while Lance Roberts sees ominous signs in widening credit spreads.
Neuner has some bullish predictions for Bitcoin with Trump's potential announcement, whereas Game of Trades ties rising jobless claims to a looming recession.
Jim Rickards isn't pulling any punches, suggesting we're already in a civil war. Despite the market's current fluctuations, experts like Chris Ciovacco and Joseph Wang see potential stabilization or further disruptions depending on political changes.
Consensus? Stay vigilant and well-informed. And don't forget to subscribe for more financial insights.
Thanks for watching Financial Insights in Minutes for July 20th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.